Hello friends, welcome back to Wellcat. So recently a good friend asked me for some investing ideas. They asked me what stock can I buy with this cash to get a better return. So I asked them what this cash was for, and they said it was their emergency fund. And I immediately stopped them and say, please don't. So this made me realize that although there may be like a million videos on YouTube talking about how to get rich or how to pick the next Nvidia, we don't talk nearly enough about the safety systems that you need before you start investing. If you invest money that you might need for an emergency, you are not really investing, you are gambling with your peace of mind. So today, I want to share my personal money bucket strategy. This is a step-by-step framework I use to decide exactly where every dollar goes. And if you're an ordinary person trying to figure this money stuff out, you can hit subscribe and we can learn and build wealth together. So, quick disclaimer before we jump in, I'm not a financial advisor. I'm just an ordinary person, just sharing what I'm learning on my personal financial journeys. Honestly, don't just listen to me. Watch other videos, other channels, read books, cross reference everything, and also be sure to check out pinned comments for our updates. Okay, let's imagine your money flows into specific buckets, and you have to completely fill the first one before you can move on to the next. So, bucket number one is the essentials. This is the money for your rent, your mortgage payment, groceries, and bills. My rule for this bucket is simple. This money needs to be boring because it moves in and out very fast. It needs to be incredibly safe. It was sitting in a checking account or just being cash. We're not trying to earn interest here. We're just trying to survive. If your budget is tight, this would be the bucket that you focus on to make sure it never dries out. For example, if you have been eating out a lot, switching to cooking at home might help quite a lot. Then, before we even think about stock markets, we need a shield. Bucket number two is what I call as the oh no fund. Life happens, tires pop, heaters break. If you don't have cash for this at hand, you have to use a credit card, which could immediately drag you backwards. So I recommend saving about 1 month of living expense or even just a fixed amount of cash like $2,000 and let it sit in a savings account. It is not a lot, but it prevents you from falling into the debt the second the surprise pops up. Now, before we start aggressive saving, we need to look at bucket number three, high interest debt. By this, I'm talking about credit debts and personal loans that with an interest rate of 8% or more. So think about it this way. If you are carrying a credit card debt from month to month that is charging you 20% interest, and after watching this video, you decide to use your cash to pay it off, that is mathematically the same as getting a guaranteed 20% return on your money. Actually, wait, no, not 20%, because you don't have to pay tax on the saved money. So it is even better than a real investment that gives you a 20% return. And no investor in this world can promise you a guaranteed 20% return. Nobody. So before you invest a dime, clear out the toxic debt. It is the absolute best investment you can make. Okay, now the debt is gone, the essentials are covered. Awesome. Now we go back and fill up that emergency fund for real. Bucket number four is a sleep well fund, which is your true emergency fund. An emergency fund is designed to protect you if you, for example, lose your job. Standard advice says to save 3 to 6 months of living expenses because that's typically the average time for a normal person to find their next job. But honestly, I am a conservative person. I prefer to play it safe, so I usually personally aim for 1 year's living expense, and some people go for even 2 years. I know that sounds like a massive amount of cash sitting in the sidelines, but if I lose my job or the economy goes rocky, this bucket ensures that my family never feels that bump. But where do we put this money? Since this is for emergencies, it should not be in the stock market, and you will see exactly why in a minute. I keep this entirely either in a high yield savings account or a short term treasury bill, for example, like a 4-week treasury bill. You want to earn a little bit of yield, but you need it to be also bulletproof. High yield saving accounts are typically offered by online banks, for example, American Express or Discover, and they offer much higher yield than any of those local banks. Nowadays, there are a ton of online banks, and many of them are not even necessarily banks. They are financial tech companies. And I personally only use online banks that already have a very well established reputation. And I avoid the ones that I'm not familiar with, even if they are promised a higher rate. Also, I personally do not favor CDs for this bucket because CDs they lock your money up for months. If an emergency happens tomorrow, you need the money tomorrow. A 4-week treasury bill is about the longest lockup period I would accept for this bucket. And now, finally, we are getting close to investing. But wait, bucket 5 is for short term goals. Do you need this money in the next 3 or 5 years? Maybe for a house down payment or for a wedding? So once at a personal finance meetup, I heard someone talking about they're having some money saved for a house down payment and they plan to buy a house in about 3 years. And they plan to follow the J.L. Collins advice to dump it all into index fund. And I had to stop them and say, well, at least to my understanding, that was not what J.L. Collins meant. Because index funds are for holding long term, not for just 3 years. Why? Because imagine the market crashes 20% right before you go and sign your papers for your new house. And that is the inevitable reality of the stock market. But now you might be thinking, well, even if I hold an index fund for 30 years, couldn't the market still crash 20% right before I need the money? And it absolutely could. But there are two massive differences here. First, over 30 years, your money has had time to multiply. A 20% drop hurts, but it's just eating into your accumulated profits. Your original savings are still safely buried underneath. And in just 3 years, you have not built that profit cushion yet. A crash eats directly into the actual cash you saved from your paycheck. And second, for a 30-year hold, you don't normally stay fully in the stock market until the very last day. You will gradually move some of the money into safer assets before you need it. But with a 3-year goal, you just don't have that runway to do this. So now if you used to have that same myth about index funds and I just helped you to clear that out, please hit the like button so that YouTube can share this warning with more people who need to hear it. And of course, if you still don't agree with me, that is totally fine too. And for this bucket, if you have a strict, hard deadline to use the money, I highly recommend keeping it 100% in truly safe assets. Now, a quick warning here. When I say safe, I don't mean blindly buying a generic bond ETF on your brokerage app, although a lot of times they are branded as safe investments. For a bond ETF, if interest rate goes up, those bond funds can actually lose money. I'm not going into the details here, but if you want to have true safety, you probably should stick with a high yield savings account or buy individual treasury bonds and hold them all the way until maturity. But what if your timeline or your budget is a bit more flexible and you really want to chase somehow higher returns? Well, in that case, you could take a small portion, like 20 or 30%, and put that into the stock market. Keeping the bulk of your money still in the safe assets helps to shield against the market downturns. But remember, you're still taking on some risk. If the market suddenly crashes, those stock investments might not bounce back over a long time. And you have to make up that lost money by saving more out of pocket. And that could easily mean delaying buying your house by some time. Alright, Now your safety net is built and your short-term goals are covered. And now we are finally looking at bucket 6, long-term investment. And this is the money you will not touch for a very long time. That's what we mean by long-term. And this is where strategies like index fund investing truly shine. And we will have a video about index investing shortly after. So make sure you are subscribed so you can get it when it comes out. But even if we are talking about index fund investing, here we have to respect the risks. I look at this in two different timelines. So scenario 1, the 10 to 15 year timeline. If you say you need this money in about 10 to 15 years, you are in a bit of a danger zone because history shows that during bad economic times, the stock market can take over 20 years to fully recover if you adjust it for inflation. If you are in this timeline or if market news make you nervous easily, standard advice suggests adding bonds into your portfolio because they help to flatten the curve. One possible setup is, for example, 80% stocks and 20% bonds, and that 20% helps to smooth out the ride so you don't have to panic and sell. As to the exact number of the bond percentage in your portfolio, different people have been having different ideas. Some people go very aggressive, like 0 to 10%, but some people saying the bond percentage number should be equal to your age. For example, if you are 50 years old right now, then your portfolio should have 50% in bonds. That is up to everyone's situation. For example, how much risk can you take? How much savings you have in total? So we are not going to dive deep in this video today because there are a lot of conversations online, and feel free to check out those resources. And we can also talk about that later in future videos as well. Now let's move on to the other scenario, the timeline of 20 years or more. Now, if this is for the future you in 20 or 30 years, for example, let's say you are in your 30s and you are planning for your retirement at 60. You have plenty of time to ride out a lot of the crashes. Many investors argue that with this long timeline, you might not need bonds at all, and you can safely go 100% stocks. But some people also think you should still hold some bonds. There's no perfect answer because even though the historical data says, yeah, it seems to be pretty safe with this long timeline, we cannot predict the future. The world changes every day, so a new pattern could come up. Who knows? You simply have to choose the strategies that lets you sleep well at night. And if your risk tolerance is relatively low, for example, your total savings is not much, I would definitely recommend you go play a little safe. And finally, bucket 7, the Vegas bucket. And this is for individual stocks, bitcoins, private equity investments, or those crazy moonshot ideas. And now I know some of you are experienced stock pickers, and you might already be typing in the comments saying, hey, buying stocks of good companies is not gambling. And you are absolutely right if you know exactly what you're doing. But for a beginner, picking just one or two stocks carries a massive amount of risk. So my baseline for this bucket is I only put money in here that I am 100% prepared to lose. So if you want to play in this bucket in the smart way, you could. You just have to diversify. For example, if you spread your money across 15 or 20 different individual stocks in completely different industries, you are significantly lowering your risk. It is highly unlikely that 20 major companies will go to zero on the same day. But if you bet all your money on just one trendy company, you are taking a massive risk. But there's an even bigger trap here that catches a lot of new investors. I want to definitely call it out. Say if you are buying a regular stock with cash, what's the worst thing that could happen? Well, the worst thing is it goes to zero. So you lose that money and it hurts, but you move on. However, if you're trying advanced strategies like short selling, meaning you are betting a stock that will go down, that math changes completely. Let me give you a real life analogy. Imagine my friend has a limited edition pair of sneakers worth 500 right now. And I think those sneakers are going out of style and the price is about to crash. So I asked to borrow the sneakers and I immediately sell them to someone else for $500 cash. If I'm right and the price crashes to 300 next week, I go buy a new pair for 300 and I give it back to my friends. And I keep that 200 difference as my profit. That is a basic concept on short selling. But here is a trap. What if a famous star wears those sneakers the very next day and the price skyrockets to $5,000? I still owe my friend a pair of sneakers and I have to spend $5,000 out of my own pocket to buy them back. That's exactly what could happen when you short a stock in the market. Since a stock's price could theoretically go up forever, your loss can be infinite. You can lose your original investment and end up owning your broker thousands or even millions of dollars more. And here is the scariest part. Where does that extra money come from? The broker doesn't care about your money in buckets. If you own them, they will force you to pay. That means one bad short sale could force you to drain your sleep-well emergency fund, empty out your house down payment, and even eat up your grocery money just to cover that loss. A single bad trade could completely destroy the financial defense system that we spent the entire video building. So for this YouTube channel, we keep it simple. We play with cash, we don't short, we don't use leverage. If I buy something risky, I accept that I might lose that money, but I ensure I will never lose more than that money. So that is my strategy. It's not a get rich quick scheme, it's a don't go broke scheme. So I would like to know if you have a better strategy that you can share, or which approach in bucket 6 do you prefer for the long-term investments? Let me know in the comments. Again, with Wellcat, we've got full videos on index funds, retirement accounts, and some tax form walkthrough, etc. And make sure you are subscribed so you don't miss them. And thank you for learning with me, and I'll see you next.